Welcome to T. Lokes, Tucson's local business podcast. I'm your host, L. Connor McEverly, and in each episode, we embark on a journey to connect with the passionate minds behind the businesses and nonprofits that make our community thrive. Join me as I sit down with the owners, visionaries, and change makers who pour their hearts into shaping the local landscape. We explore the challenges, triumphs, and unique journeys that define Tucson's business community. From the corner coffee shop to the innovative startups and impactful nonprofits, T. Lokes is your window into the diverse stories that make our city special. Tune in and get ready to get connected. This is T. Lokes. Howdy, folks, and welcome to T. Lokes, your Tucson local business podcast. I'm your host, L. Connor McEverly, and here with me in the studio today is your local licensed mortgage professional with 4 years of experience from Fairway Independent Mortgage. It is my pleasure to introduce to the show, Kyle Sanders. Kyle, how are you doing today?
I'm doing fantastic. I'm really excited to, meet and connect with you and talk about my business and how I can help people.
Yeah, I'm really excited to have you here. Thanks for being on the show.
Yeah, absolutely. Thank you. I've been wanting to do this for a while, and I'm glad we were able to connect and do it.
Yeah, me too. So without further ado, let's crack into it. So tell me a little bit about Fairway Independent Mortgage and the services you provide.
Yeah, at Fairway, we are a retail lender, so that just means that we generally will fund the loan initially, and then we then sell that off on the secondary market. So we provide the financing ahead of time, and then your loan would then go to someone that does what's called servicing the loan. So, and that's where you make your monthly payments and set up all of your insurance and taxes, things like that. So at Fairway, though, the cool part about kind of being that retail is we do everything in-house in relation to the underwriting, the processing, collecting all of your information, and making sure that we're able to get the loan approved and done in a very timely fashion. So it does give us a lot of control to make sure that we can give you the best speed and service all in one shop.
Nice. That's great.
Yeah.
So what is your personal or professional mission statement? Like, why do you show up every day?
Yeah, for me, kind of my mission statement is I want to help Americans build wealth through home ownership. And so that's really why I show up, because for me personally, having a family and then also being a homeowner, I see the value in having equity. And the big thing that really hit home for me, before I started in the mortgage industry was I rented a lot and bounced around in a different career because I did want to have that mobility. And I always said once I became kind of a district or level 3 manager, then I would buy a home because I knew I'd be in that location for at least a year or two minimum. Right. And so the crazy part is, being in that location, I then ended up leaving that career and coming into mortgage. But on top of that, I've gained more wealth as just a homeowner because I bought my house in 2017. And then it's, exponentially grown since 2020 to today as well. So that's the biggest part for me is I just had to make my payment on time. And I've made more money now than it took me 12, 13 years in a previous career in my retirement fund. So I have the same equity that I do in let's just call it 11 years of building a retirement fund. So, and that all happened in a very short amount of time.
Wow. So getting into real estate, definitely seems like a very lucrative thing to do. You are a testament to that. And, for folks who, want to, buy their first house or maybe like get their first rental property, if they want to start that process of buying a home, where do they start?
Yeah, the first thing is get with a licensed loan officer. So, because what we look at on the lending side of things is the 3 main parts to a loan. So there's your credit scores and your credit report. That helps us not only tell you what loan products are available, but it also helps us build what's called your debt profile. Okay. And so the debt profile is all the loans you have, credit cards, student loans, anything that you have financed. And then we use the minimum monthly payments or what our guidelines have us calculate the payment as, depending on student loans versus like a truck payment, for example.
Okay.
So once we have the debt profile, the next is your income profile.
Okay.
And that has to do with your employment history. General rule of thumb is you need 2 years of employment history. Doesn't necessarily have to be at the same job, but that you have that history and you can show that you've been able to hold that position. There are other ways that you can do that. Let's just say if there's a job gap of more than 6 months, or if you've been at a certain, gone from like a self-employed to now a salaried or W-2 position.
Right.
So there are definitely ways that it really is important that you get with a great loan officer, because they can walk you through what options you have available depending on your history.
Right.
So with the history, we then also calculate the income. And that depends, again, on the position and what type of income you're receiving. So once we have the income profile, then the last part is your down payment and or cash to close.
Okay.
So that's kind of just the money side of it.
Right.
So that's where we start with the credit, then go into the income. What can you afford? And that does your debt to income ratio.
Okay.
And then on top of that, will you be bringing the down payment? Will you have gift funds? Will it be something from a retirement account? Or there are a lot of down payment assistance programs out there that can help first-time home buyers and repeat home buyers, just depending, again, on your total profile.
Wow. It's a lot of good information.
Yeah.
Wow. So, I mean, clearly there are a lot of steps, a lot of things to go through. And I mean, you're a professional. So, I mean, you laid this out real clean and easy for us to understand. So maybe for those, who are interested in, buying a home, what are maybe like some do's and don'ts of financing a mortgage? Does that even make sense?
Yeah, it does, for sure. The biggest kind of, let's just say the do's are going to be your employment, again, that employment history piece. So where is your income coming from, whether it's employment income, retirement funds, Social Security, disability. If you're in the military, there are ways to do that as well. So the income piece and showing consistency. So the key there is don't go to 7 different jobs and, work at McDonald's, then Burger King, then Chick-fil-A, then Chipotle, and continue to do that. We underwriters want to see some longevity.
Right.
You can do it if you change jobs, and we can even potentially use like an offer letter depending on how it's structured.
Right.
So there are options to it, but the general rule of thumb is consistency and longevity in your employment.
Right.
Credit-wise, make sure that you're making every single payment on time. That is absolutely crucial. We can do things to try to help improve your scores, but the one thing that will take you out sometimes for a year or a time period are frequent lates on not making those payments 30, 60, 90 days late. So on-time payments is absolutely crucial. And then the other one I would say too, some, don'ts, I guess, would be more of once you're in this mortgage process, don't change your debt profile. So buying a new car, getting excited about your new property and financing furniture, all those types of things can affect that debt to income profile and could potentially take you out or have to make us make a shift or bring more money down, and things like that. Right. So those are the types of things that once you're in the process, I always say, keep that debt profile the same or potentially a little bit better.
Okay. So, I was thinking, you mentioned about kind of like consistency and work history, and I think it's pretty common nowadays for people to switch jobs with some regularity. Obviously, you can't have someone who's like just hopping from job to job just every few months at a time. And, for some folks who are maybe like starting a business or who are self-employed, is there something different that you measure when someone is self-employed, or does that make a difference in employment history? Yeah,
on the self-employed side of things, if you're going to be using kind of the main investors, so the government side is FHA, USDA, VA.
Right.
Or if you're going to be using the conventional options, Fannie Mae and Freddie Mac, then their general guidelines are a 2-year of tax returns.
Okay.
Because self-employed goes off of the tax returns, and oftentimes the baseline for it is your net profit number, not your actual revenue number.
Interesting.
So I always kind of joke, but taxes and mortgage are the exact opposite. On the tax side, you want to show as little income as possible so you don't have to pay as much tax. Mm-hmm. On the mortgage side, you need to show enough income, even if it does mean you might be paying a little more taxes, because we start with that baseline number, and then there are certain things that you can add back to be able to strengthen that profile. So now, that being said, if you don't fit that, there are other ways to potentially do that, depending on how long you've been self-employed.
Right.
Because sometimes if you've been with that same employment or that same company for 5 years, then you can only use 1 year of tax returns. Mm-hmm. So, or there are also kind of some non-qualified mortgage options that sometimes can go just off of a 1099. Mm-hmm. Or we have other options called like a bank statement loan where we calculate it based off of the investor's guideline for either 12 months or 24 months of bank statements. Now, those loans generally tend to need a little higher FICO and a little more down payment. So closer to like a 15-20% range.
Right.
Versus if you're doing a Fannie Mae or Freddie Mac 5%, or even they even do have some first-time homebuyer programs as low as 3% down payment as well.
Nice.
So there are ways to really get you financed. It just depends on your entire profile. And it really depends on what type of loan product that you're doing. And that's where we, as the mortgage professionals, have to know, your entire profile to be able to best help you.
Right. Definitely. And to touch on another thing you said, in terms of like making, or I forget exactly what you said, but like watching your debt when you're in the process of getting a mortgage. So, I mean, I guess just to put it in even simpler terms, like don't make those big purchases or don't take out, more loans when you're applying for like a mortgage, because they'll mess with you. Wait till after your mortgage is done, or.
Yes, and that's actually one of the questions that just recently was uploaded in the last few years on the actual mortgage application is, are you planning on opening any new debt in this process? Because what happens if and when you do that is it could change those debt to income ratios, especially if you're kind of pushing the higher amount of debt to income in order to get a little better purchase price.
Right.
And then also it could affect the closing timeline because most investors require what's called a credit refresh, not pulling a new report, but just pulling a refresh to make sure that no new debt has been added. And if new debt has been added, then it just depends on the amount of debt and can your profile absorb that as well. So that's why it's a big one of, and adding new debt is based on actually running credit and doing a new installment loan, opening a new credit card. If you go and pay cash for something, then that's fine as long as we didn't need that cash for your home purchase. Right. So that's why it's really the key to everything is just communication and talking with your loan officer. So because if you do have something where your car breaks and you're 10 days from closing and you got to get to work and you need to do something about it, that's where your loan officer can best advise you and say, hey, this is what we need and this is our plan and strategy to make sure that we can still close and close on time.
Gotcha. Howdy, listener. Are you also a podcaster seeking to stand out in the crowded audio landscape? I'm here to help. L. Connor Voice, LLC, offers top-tier audio engineering, meticulous content management, and more, all tailored to save you time and elevate your podcast to new heights of professionalism. With L. Connor Voice, you can focus on what you do best, creating captivating content, while I handle the rest. Say goodbye to hours spent tweaking audio levels and managing uploads. I ensure your podcast shines with polished sound quality and seamless delivery. Ready to take your podcast to the next level? Contact L. Connor Voice, LLC today and make producing your podcast as easy as hitting record. For more information, go to lconnorvoice.com. Links are in the episode notes. One, it's very clear that you have a great amount of knowledge around financing, mortgages, and loans. Where I'm sitting, it seems like there's a lot of nuance because I really don't know that much. But what might be some common issues that someone has that you may be able to help them solve for the new home buyer?
Sure. I work with a lot of clients that maybe have had some challenges with their credit, either currently or in the past.
Right.
So one of those is helping them with their credit. Once I have a credit report, even one bureau, I can go through and run some simulators and say, hey, if you're able to do this, this is how it could affect those scores directly.
Mm-hmm.
Now, it's never a perfect exact science because credit reports are constantly updating and living, breathing items.
Right.
But being able to help somebody and show them that it may not be as far away as they think. Because I found, especially on kind of the mid to lower credit spectrum, there's a lot of feeling of, I'll never get there, or, man, it can happen to everyone else, but not to me.
Right.
And that's where I'm here to be able to help and assist. And another way that I and our team can really help is just being able to show people, hey, what is your goal with this property, whether it's an investment property or it's your own primary residence, that's a multi-unit that you're having as a home, but also making money from that.
Mm-hmm.
Or it's your first-time home buyer, and this is your time to really start building equity and start building wealth. So because I saw a statistic towards the end of last year, but if someone is renting, then the average wealth of homeowners renting is, in general, and this is total wealth, all your accounts, your equity, your net worth, basically, for renters is in the low thousands. The average net worth of a homeowner is $250,000 in America. So there's a $200,000 to $240,000 swing just by being a homeowner in the average net wealth.
Right. And that's a really impressive statistic. And I mean, that's not really knowing that statistic at the time, but kind of understanding that there would be more value towards buying a home is why my wife and I bought the home we're in a few years ago. And that was a challenge. And, we had help from family as well. And we're very fortunate to have that. But for some of those folks who feel like it is out of their reach, what are maybe some steps or some tips that you could give them to kind of help disperse the illusion that they can't purchase a home?
Yeah, absolutely. I mean, the first one is to start building credit. If you don't have it, or if it's not strong, then get with a licensed professional that will help you with that. So either creating credit or building credit. Great ways to create credit are getting just a credit card, paying $10, $20 a month on it to get that repetition and show that you're using but not overusing credit. Right. If you don't have the option of purchasing an auto loan in cash, then starting with a small auto loan, not overextending yourself, but starting out small and kind of building from there. Another way too is becoming an authorized user on a family member, a parent's account, something along those lines. But the key there is you can add great history, but you have to really be firm to make sure that it is great history. Because if you get added to an account that's got 5 years of history, but they've been 30 days late 10 different times, or 60 or 90 days, that can actually have the adverse effect and hurt you for some time. So that's the key there is if you want to go that route, it can be an awesome route to manufacture a score almost instantly because you're using that positive credit history and longevity. So, but other ways too, I mean, there are ways to do what's called non-traditional credit. So for those that don't like to have debt or are a cash only, there are other ways to be able to do that. And that has to do with showing payment history. That could be doing a verification of rents with a landlord. That could be showing different types of debt you may be doing, like phone bills, electricity, water bills, things that you do have to pay monthly, but aren't necessarily on your credit report. So, and another way too is there are some programs out there that can report to the bureaus your payment history on utilities, bills, different things that way as well. So there are definitely ways to build that credit profile.
Right.
And then another one is just really just focused on having that, again, that longevity of your employment history. Right. So you can technically bounce around. FHA has certain guidelines where if you do more than 4 positions or 4 or more positions within a year period, then you do have to wait 6 months at your new position. Gotcha. So again, all underwriters are really looking at is they want to see a history, and then they also want to see potential continuance. And a lot of times that history, the 2+ year history, is what then kind of gives that continuance side of things as well. And so yeah, really it's consistency. Never, ever, ever be late on your payments, 29 days or less. And then also the other part too is just, and this is kind of going down a different path a little bit, but just really sit down and start budgeting and start planning on what can I truly afford? What do I bring in? What are my costs? What's left over? And that's where you look at it. And that's also what I do. That's basically your debt to income ratio. What's brought in? What do you have to pay out every single month? And what can you afford as a monthly payment?
Yeah, never underestimate the power of budgeting. It can answer so many questions for you. It can really, for me, I know that like budgeting really helps ease my mind, helps me know what kind of decisions I should and can be making. Also, I just wanted to touch on something you said, because I thought that was really fascinating. I don't know how much more I have to say on it, but the idea of the showing history of paying your utilities as kind of a form of showing that you can make consistent payments and keep up with these things. That's really interesting. I've never heard of that and never thought of it really. How impactful is that? I mean, as opposed to other forms of credit.
Sure. Yeah. That's the non-traditional credit route. And that's basically where they want to see exactly that. Like, can you make those payments, and can you make those payments consistently every single month? Mm-hmm. So a similar thought process is, for example, if someone wants to use child support income that they're receiving, mm-hmm. the 2 questions that I ask immediately are, is it court ordered? Meaning, are they kind of forced to pay it? Mm-hmm. And then 2, is it consistent? The exact amount that's due every month. Mm-hmm. Now, you can use kind of partial payments to where they add up to that in that monthly period. Mm-hmm. But the initial guideline starts at like a 3-month history. Mm-hmm. But if you see that, let's just say they owe 500 and it's like 100 here, 400 there, they skip a month, and then there's another portion. Mm-hmm. So that's where you then have to go further back and look at an average of 2-year history.
Right.
So those are the types of things. And you can, on certain investors, not have to have it court ordered. You can use just an agreement. But sure. The absolute key on that is the history of payment. Right. And that is really what shows the potential future consistency. Right. Because to break it down with underwriting and the guidelines and, like you were kind of saying, it can make your head spin. Yeah. All underwriters are really doing, or at least the ones that I've spoken with at Fairway and the ones that I've talked to, and just my interpretation of all these guidelines, they're just basically saying, can this person afford it? And if I'm giving you income, like let's say bonus income to make your profile to get you a more expensive property, I want to be able to show that that bonus income is going to continue, but I also want to err on the side of caution because a big portion of what happened in 2008, 2009, 2010, that huge market crash and all those defaults and everything else was the lending didn't have that structure and it didn't err on the side of caution. So people were overlending, overspending, and that was one of the factors that led to that huge crash.
Wow.
And one part of that, why today, because when it comes to a market crash, there has to be, the supply has to heavily outweigh the demand.
Right.
And one of the main factors that isn't happening today is lending has tightened up and lending has gotten even more strict. Even in the current inflation, in the current rate market, all those things have made it where payments have risen and income hasn't necessarily risen. But that being said, the guidelines haven't changed and they haven't softened those guidelines, knowing it's harder for people to be able to make these higher payments because they have less income, less disposable money because it's being spread over a lot of different factors. I mean, going out to a fast food restaurant, any meal is $11 to $15 for one single person.
Yeah.
I mean, there's no dollar menu anymore.
Yeah.
So those types of things, lending has still stayed the same and consistent. And that's a big factor to why the housing market isn't seeing massive amount of defaults, because they're not lending to people that shouldn't be lent to.
Interesting. But that makes a lot of sense. So I'm sure that there are a lot of folks out there who feel like they might be the kind of person that shouldn't be lent to. What is maybe... I'm trying to put this question together, but like, where is a moment where you were able to show someone that they actually can be lent to? Like, what's like a moment of achievement, like a milestone where you helped someone who didn't think they could and you helped them do it?
Yeah, I've had quite a few clients that, for one reason or another, I mean, I've worked with them. It took them almost anywhere from a year to 2.5 years.
Wow.
So, and I was even talking with one of my close partners, a real estate agent, about just doing the right thing and being consistent and following up and helping people down that path. Now, that's not the ideal scenario for anyone involved, just in the length of time and the challenges. But it really just goes to show you that really a large majority of loans, like I would say that almost all loans, it's not a matter of if, it's just a matter of when.
Nice.
And that's the biggest difference is I can't put in the work for you though. That's back to the budgeting piece. That's back to making your payments on time. That's back to making those financial decisions to help set you up. Because the biggest thing in real estate that you cannot manufacture or you cannot get back is time. And that's why it's so important that if you can purchase, start the clock. Unless you're going to be flipping houses in 90 days and you have the know-how, the expertise, the finances to do that, then time's a little more about kind of timing for you and the market and so forth. But most homeowners are going to be there anywhere from 3 to 5 years in each property. And a lot of times they may only have that exact loan for 2 years or less because of either a refinance, their life changes, they've got to sell, they upsize, downsize, they have next thing twins are coming, all those types of things. Life happens. So you have to start the clock, because if you're making your mortgage payments on time, historically, the real estate market has risen by 4% or higher since 1923. I think there were only 3, maybe 4 years it was ever a negative. So it's been a positive since the 1920s. And that's just sitting there for you all you have to do is just make that payment on time.
Right.
So as you do that, you pay down, it's less in the beginning, but you start to pay down your principal.
Mm-hmm.
You gain equity through the market values rising. Then when you have to make that change, downsize, upsize, whatever that is, that's now allowed you to take some of that money that you didn't have. And it was, almost given to you for free because you need to pay some sort of shelter,
Right.
Whether it's renting or purchasing. Then you take that, and that's where you could then maybe get a little bit bigger and better property, because now you do have the down payment that you didn't have 2, 3, 4 years ago or 5 years ago. So that's the thing, is it can work as kind of a savings account for you. Or a lot of Americans right now are heavily leveraged on credit card debt and debt in general. So I have a client in Colorado that's selling their home, and they're about to close on the 30th of April.
Mm-hmm.
They're going to take a huge portion of their equity, pay off all of their debt aside from student loans,
Mm-hmm.
and that's going to improve their credit score by 100+ points, which will then in turn allow them to be qualified to purchase their new home down in Florida.
Mm-hmm.
And they're then going to be able to afford not only the home in Florida, but they're going to be setting themselves up on a monthly perspective substantially. But if they weren't homeowners, none of that would have been possible.
Wow. Just so clear, like the advantages to having like real estate, to having some property. And, I guess, and especially in the context of maybe like a new homeowner or someone who wants to get their first investment property, like what might be some signs that they should reach out to you?
I would say the moment that they really are committed to start shopping. So because sometimes we can get them pre-qualified in hours if you give me the information that I need, because a credit check takes seconds.
Mm-hmm.
And then depending on their profile, whether or not it's self-employed or a W-2 position, things like that.
Right.
So we can move very quickly. And also on top of that, it's when they feel that they're serious about looking,
Mm-hmm.
and most importantly, just to know where you stand. Even if they don't have to purchase at that exact second in time,
Yeah.
it's good for them to know where do they stand, what would the payment look like, and that's where you can then go back to and revisit that budget and say, hey, is this right for us to do it, and do it right now?
Right.
So because there are also programs as well, I've got another client that I'm working with that's doing what's called a 2-1 buy down program.
Okay.
And he was hesitant because of the monthly payment amount. Well, this program is allowing, and this is all paid for by the seller.
Mm-hmm.
So the seller's giving him $7,200 to pay $400 less on his first year and $200 less on his second year. And then by the third year, he will have either refinanced, or he will, his wife was also potentially going to get a job shortly.
Mm-hmm.
So that will give him 2 years to work on his debt and his income to be able to, as an absolute worst case scenario, start making that higher payment.
Right.
But that gives a great way for him and his family to transition into that higher payment, should he not be able to either refinance or do another type of financing with that loan.
Gotcha. Swan, this is a lot of really good information, and I have a lot of questions, but we're also running short on time. So if some of our listeners who are like me and they want to learn more and they have more questions, where can they go to hear more of your insights or get in contact with you?
Yeah, you can either go to Fairway Independent Mortgage, their website, and then search my name, Kyle A. Sanders. My Instagram handle is at Kyle A. Sanders 11.
Okay.
Or on Facebook. I'm active mostly on Instagram and Facebook. Search Kyle A. Sanders and you'll see my name and my professional headshot on there as well. And so the key is just to start with the initial application, and then we'll talk about it and we'll get to know each other and see what your goals are and be able to help you accomplish those goals through financing.
Awesome. Awesome. And folks, I will be putting links to Kyle Sanders' socials in the episode notes. So if you want to go and talk to him, Those are right in the episode notes. Go and check those out. Kyle, the final question, the question I ask everybody, is out of the many, many things, what is one thing that you love about Tucson?
That's a hard one because there's a lot of things I love about Tucson. I would say the one is just it's a great place to raise a family with a competitive cost of living. Mm-hmm. And I do have to throw in that one of my favorite golf courses is 5 minutes from my doorstep.
Oh, nice.
So, and the final one too, I'm originally from Colorado, and here we shovel sunshine about 360 days a year,
right?
Something like that.
Yeah.
So I figure it's a pretty good place to stay and raise a family, and it's not super expensive, at least in this moment in time. So I'm pretty happy here.
Absolutely. Yeah. The cost of living here is fantastic.
Yes, it is.
Well, Kyle, thank you so much for coming on to the show today and talking with us about Fairway Independent Mortgage and, how folks can get into a house.
Yeah, absolutely. Thank you, Connor, so much. I had a blast. So it was a lot of fun, and hopefully I tried to make it as easy to digest as possible. But either way, I'm just really excited to be able to get the word out there and help people to start kind of build that generational wealth for sure.
Absolutely. Thank you so much, Kyle.
Absolutely. Thank you.
And that's a wrap for another episode of T-Lokes, your go-to podcast for uncovering the untold stories of Tucson's local businesses and nonprofits. A big thank you to our incredible listeners for joining us on this journey of connection and discovery. A huge thank you to Kyle Sanders from Fairway Independent Mortgage for coming on the show today and showing us that getting your first home isn't quite as scary as you think it might be. Show them some love and check out their links in the episode notes. A huge thank you to Louis Sanders at Soundhouse Publishing for making our unforgettable podcast theme music. If you enjoyed today's episode and want to stay connected with Tucson's vibrant business scene, don't forget to subscribe, rate, and leave a review. Your feedback is invaluable, and it helps us continue bringing you engaging conversations. As we wrap up, remember that T-Lokes isn't just a podcast, it's a community. Let's keep the conversation going on social media. Follow us on Facebook, Instagram, or our Discord channel and share your thoughts, suggestions, or even recommend a local business or nonprofit you'd like to see featured on the show. Thank you once again for being a part of the T-Lokes community. Until next time, stay connected, stay inspired, and keep supporting the heartbeat of Tucson. Toodaloo.